Welcome to QuickBooks at Kapiolani Community College. This video will go over the basics of payables and purchases for a service business. In Chapter 4, many new transactions are introduced and it's easy to get them mixed up. Here are some problem areas that you can expect in the payables and purchases area. Entering bills, paying bills, writing checks, and expenses are all a different thing. What's the difference? If you enter a bill, that's for a purchase of something, goods or services, on account. And there are a wide variety of possible accounts on the debit side. For example, it could be supplies, maintenance expense, equipment, and many other possible accounts. Anything that you could get a bill for, basically. And the credit side is accounts payable, the name of the vendor that you're receiving open account credit for. Paying bills, on the other hand, is for payment of any bill that's previously been entered. So it's for payment of vendor on account. And you debit accounts payable for the vendor name and credit your checking account to pay them. That's when the check is generated by the system. So you go in the system and you say, I want to pay this outstanding bill. Now, writing checks is a separate thing. Where it is a two-step process to enter a bill and pay bills, it's a one-step process to write checks. So this is when you purchase supplies or some kind of services or goods from someone, and usually, and you're paying for it right then by a check generated by the system. Now, the most confusing item is probably this last one, which is known as expenses, because that's always a kind of a misunderstood word anyway. Expenses are for any credit card purchase, any petty cash purchase, and after the fact entry of a check purchase and payment. So if you purchase something with a handwritten check and later on you came into QuickBooks to enter the handwritten check, that would be an instance where you would enter an expense, quote unquote. So same kinds of accounts getting debited, but just different sources of funds. Credit card payable, the petty cash account, or your checking account through manual check entry. Now if you mix these different types of transactions up, lots and lots of balances and transaction links will be wrong. So you have to be careful about recording things in the proper area. Think about what is the nature of the item that you're recording. Is it a direct purchase? Is it a purchase of something on account? Are you using a credit card? All of those are a different type of transaction with different debit and credit consequences. Credit memos are vendor credits. And if you enter bills, go into enter bills and you click the credits button to enter a credit memo for received from a vendor, your bill should then change to enter credit. Now what does this mean? It means you're reducing your accounts payable, that liability account getting debited is going down, and you're reversing out whatever it was that the item originally purchased was, or paid, or service received was. Now you eventually have to apply credits in order to make the related accounts payable invoice clear out. Otherwise, the original vendor invoice and the vendor credit will both show up in unpaid bills. So here's a bunch of detail here given in this link to a discussion on the QuickBooks online site. But essentially what I'm talking about here is if you apply the credit memo, that means you match the credit memo to the vendor invoice that it relates to. And when you clear the invoice, that means the invoice stops showing up as an unpaid invoice balance on your reports. Now, an example inside of QuickBooks would look like this. This is a outstanding balance, a bill for purchase, in this case of merchandise. It's a later chapter, and a credit against some of that for a return of some of that merchandise to the vendor. So notice that QuickBooks has already checked off that vendor credit as probable to be included in this check that in this bill payment that I'm trying to make to the vendor. So the actual amount owing is $3,800. There's a credit of $75, and QuickBooks is proposing to me that I pay $37.25. Take the credit and do that. Now if I don't want to take the credit at this time, or I want to take a different one, then I can always go ahead and add the credit in and accept the suggestion essentially that QuickBooks gave me. Or if QuickBooks hasn't figured out what I want to match up with this, then I can go ahead and do that and apply that credit. Now, if you run across invoices that don't seem to have any matching expenses on your income statement, like you drill down through an expense on the income statement but you don't see it, but yet you can find this invoice in your records somewhere way back there. Whenever a vendor account is set up and has an opening balance, QuickBooks makes an invoice to match that opening balance. So the only practical way for this to happen is at the point where the account gets created. And uncategorized expense, or also known as services in newer QuickBooks Online, gets posted to the period just before your current period, preferably. So back in Chapter 2, when you set up your vendors with payables, you would have generated these kind of mysterious looking invoices. Don't go deleting them, because it's not practical for you to recreate them, and you're going to mess up your balances. Now, if you're entering vendor credits, and that is not the same thing as changing the balance due on an invoice. So going in and directly changing a vendor balance due because you know that you got a credit from them destroys your audit trail. You want to keep the audit trail, so to do that you want to show each transaction as it happened. Original invoice, original amount, traceable to the original invoice. Vendor credit, credit amount, traceable to the vendor credit. Stick the two together, cut a check for it, no problem. Change one, throw the other one away, problem. So you want each item entered as it really occurred. So if we're maintaining control over cash disbursements, usually checks, which is typically our largest source of cash disbursements, a company should have checks that have their name and address and the bank account number and the routing number and everything, as well as sequential check numbers printed on them. And those check numbers on the physical check should always match the pre-numbered number that pops up in QuickBooks. So we have different security levels of checks. The least security comes with a wallet-style blank laser check, and embezzlers can just scan a laser image of the signature onto this check with Photoshop, change their payee in QuickBooks. The only evidence you would be able to find about that would be a bank statement image of the check, and then who's going to be actually looking at those? Often nobody does. Now the highest security level comes with high security checks. Those are pre-printed, pre-numbered. They have a voucher stub, they have a duplicate copy, dual signatures are required, and you keep a dedicated check printing printer that is kept in a locked cabinet or has password protection or physical access controls on it. And your checks are also kept separately from, or not available for any employee to grab. So here's examples of a check that's a super high security check. If you look at this guy, you'll see it has like a holographic printing on it. It has tamper-proof paper. It has just all kinds of good stuff. Yeah, not very big, I guess, huh? Anyhow, you can see the printed background looks kind of like a bond or a dollar bill or something. It has holographic imprinting on it, and pantograph, I guess it's called. Verification grid. You try to photocopy it, the word void pops up, and has other visible security features. So that most secure alternative is kind of extreme, but that would be a real good option to have if you want to have some good control over your checks, especially if they're prone to being played around with. Now, if you void a company check and you delete a company check, that is not the same thing. Voiding says we wrote this check, we decided we no longer want to issue it, it's now being voided. The actual check should be retained, should write void across the front of it, and then you should check to see that paid checks don't include, of course, that check number. Smaller cash disbursements happen with petty cash funds. Petty cash funds are for kind of small purchases, last minute things, small quantities of items that are, don't break your petty cash box amount. And typically petty cash should be something like a fund of maybe $100 to maybe $300 to $500 max. And the disbursements in there should be probably, I'd say, like less than $100 and more like 50, 75. So the cash should be kept in a locked cash box, and you should have somebody who's a petty cash custodian who's not the person who does the accounting for it. So the petty cash custodian takes the cash, takes a check to the bank, cashes it, and brings the cash back to put in the petty cash box. So most petty cash systems have historically kept the petty cash balance at a constant level, like $100 or $300, and then when the fund gets reimbursed, when you decide that it's kind of low and you need to put the money back in, that's when the expenditures actually get recorded. So here's an example of the kind of reimbursement of a petty cash fund in most systems. Now notice that you don't actually record these expenditures till the point you write the check to reimburse the fund. And your check or your double check should be that if the reimbursement amount isn't the same as the amount of cash that you don't have in the petty cash box, then something's wrong. Now QuickBooks treats the petty cash fund differently than the traditional type. It treats it pretty much the same as like a checking account. And reimbursement checks from the company's checking account just really are transfers back into that account to bring it back up. So this same petty cash expenditure showing up top here, when done in QuickBooks, the credit will be to petty cash, not to checking. And so the expenditures show whenever you get around to recording that a petty cash expenditure was made. It doesn't have to wait until the replenishment. And when you do the replenishment, all you do is transfer the missing money from petty cash back into petty cash out of checking. So now if this new petty cash balance, prior to replenishment, isn't the same as the amount of cash new petty cash balance after replenishment isn't the same as the amount that's supposed to be in the petty cash box, then something went wrong. Okay, this is a quick overview of QuickBooks Payables and Purchases cycle. Hope it helps. Thanks.